Imagine you just paid off the final $4,000 on your car loan. 4 years of payments. Finished. No more debt. You open your banking app, expecting financial validation. But 2 weeks later, your credit score drops. You borrowed money and repaid every dollar exactly as promised. By every traditional definition, you acted with total responsibility. Yet the system responds as if you are now a higher risk. This happens because the score operates within a very narrow window. It tracks specific debt signals while ignoring your total net worth, your liquid savings, and your overall financial stability. You can earn a high salary or keep tens of thousands of dollars in a savings account without moving the needle on a standard credit score. Even paying rent on time for a decade often goes uncounted. The model simply isn't looking at those parts of your life. The entire system is designed to predict one variable: the statistical likelihood that you will repay future borrowed money. Because the model relies exclusively on borrowing data, a person who lives entirely debt-free provides no evidence for the algorithm to analyze. To the machine, a perfectly responsible but debt-free consumer is an unpredictable ghost. Credit bureaus act as the librarians of your financial history, holding the raw evidence of your behavior. The score is the verdict, a mathematical prediction generated by a specific model. The standard FICO calculation weights 5 categories. Payment history is the most influential. It catalogs every time you paid as agreed, but also notes how late a payment was, how recently it happened, and how often the pattern repeats. Then comes the amount of debt you carry relative to your limits. If you are using 90% of your available credit, the model interprets that as a sign of extreme financial stress, even if you have the cash to pay it off tomorrow. The length of your credit history adds weight to the prediction. The algorithm rewards long-term observable patterns, valuing a 10-year-old account far more than a brand new one. New credit applications and the variety of your loans round out the calculation. When you pay off a loan and close the account, you are changing the age and the mix of your active profile. The algorithm doesn't see a victory, it simply recomputes the new data. This is why your score might drop after you clear a debt. By removing that account, you've altered the structural age and variety of your credit file, triggering a new, slightly lower mathematical snapshot. The algorithm operates without human context. It doesn't celebrate your freedom from interest payments or punish you for leaving the system. It just updates a risk profile based on the remaining evidence. This 3-digit number acts as a gatekeeper in the physical world. It determines the interest rate on your mortgage, the likelihood of a landlord accepting your application, and in many cases, your eligibility for a job. There is a direct mathematical penalty for a lower score. A few dozen points can be the difference between a standard interest rate and a predatory one, significantly increasing the cost of basic necessities like a car or a home. Higher interest rates lead to larger monthly payments, which systematically drain your available cash. This leaves you with a smaller margin for error when life becomes expensive. When an emergency hits a depleted cash reserve, a missed payment becomes almost inevitable. That new negative data is fed back into the system, driving the score even lower and the interest rates even higher. The algorithm effectively compounds financial pressure, manufacturing the very instability it was designed to identify. The system's greatest weakness is its blind trust in its own inputs. The algorithm assumes every reported late payment or collection account is a factual truth, even if it results from administrative error or identity theft. Protecting yourself starts with understanding how to check the evidence. Reviewing your own report is a soft inquiry, which carries no penalty, unlike the hard inquiry triggered when a lender pulls your file for a new loan. Defending your score doesn't require carrying unnecessary debt. Reliability comes from 2 primary behaviors: paying every reported obligation on time and keeping your revolving credit balances as low as possible. The model remains blind to the human side of finance. It cannot see the context of a medical crisis, the sudden survival of a job loss, or the effort required to rebuild a life from nothing. A credit score is a mechanical prediction of risk, a tool used by the financial system to determine the market price of its trust.